Hi, this is Vijay Bambwani, and in this video, I'm going to talk about ETFs, exchange traded funds. The one that I promised you I would make, but this time instead of gold ETFs, I'm going to talk about index ETFs. So I'm going to talk about Bank Nifty ETFs, I'm going to talk about the Nifty 50 ETFs, and surprise, surprise, the BSE Sensex ETFs. Now, what are ETFs? ETFs are nothing but by deliverable, I mean electronically demat account deliverable. So ETFs are nothing but electronically deliverable index units which you will get in your demat account exactly like shares. And being deliverable units of the indices, the ETF fund manager will hold each stock of that respective index in exactly the same proportion as it is weighted in the index. So each ETF's portfolio will mirror the others for the simple reason that they all, if it is a Nifty 50 ETF, they will all be holding those same 50 shares in that same proportion. The only thing is execution costs, timing of rejigging the portfolio will basically differ. Now the reason why these ETFs do well is because they are passive in nature. Index funds, any mutual fund investor will know this immediately and off the hook, that index funds are passive in nature. They basically buy the stocks in the same proportion as the index that they are investing in or trying to mirror the performance of. And unless the constitution of the index changes, the fund manager does not rejig or buy and sell or shuffle the portfolio, which is why their execution costs are absolutely low compared to active funds like equity funds, small cap, large cap, mid-cap funds, etc., where the fund manager is constantly buying and selling, paying brokerage, administrative expenses, custodial charges, etc., etc. Now, these ETFs, therefore, tend to largely have performance which is very similar to each other with slight variation. Now, between these ETFs, there are three things you can do. Number one, choose the best sector, either the Sensex, the Nifty, or the Bank Nifty. Thirdly, once you choose the sector, you basically choose the top three ETFs within the sector. Fourthly, you can basically do a mix and match. If you're somebody who believes in asset allocation, you might want to keep your feet in both the categories, the Bank ETF as well as the frontline ETF, either the Nifty 50 or the BSE Sensex, or hey, even both. Now, to learn more about these ETFs, I would strongly suggest you read this wonderful book. It's titled Outpacing the Pros. It's written by David M. Blitzer. It's a low-cost book. It's a fantastic book about how to beat professional investors by investing in index funds. For cross-referencing, I would strongly suggest you scroll back or scroll down in this playlist rather and go back to my video dated 4th of January 2021, this very year, a little more than a week ago. The title of that video is Index or Stocks, Where Should You Invest? In that particular video, I've elaborated why indices in India either resist falling or when they fall less than stocks, because the constituent shares weightages keep changing as per the free float method, and when the stock price of a weighted stock in the index falls, its weightage also comes down. So the fall or the blow onto the index is therefore muted. Now, coming to, I hope I have convinced you that ETFs are making eminent common sense as compared to buying futures in the Nifty or in the Bank Nifty and then rolling over these futures expiry after expiry in order to take a longer term view on that respective index. You see, you'll keep on paying recurrent charges and probably, depending on what the prevalent situation is that time, you will wind up paying anything between 9 to 15% rollover charges per annum if you were to take a buy and hold approach or a patient buying approach on the Nifty or the Bank Nifty. I think if you're taking a longer term approach, it is better to take delivery via these ETFs. So first of all, the primary observation that I made was when I checked out the Nifty Bank ETFs or even the banking ETFs, their 1 year returns. I'm basically grading them as per 1, 2 and 3 year returns. Secondly, liquidity in the market. Thirdly, of course, not necessarily in that order of preference, the promoter. Now we need good solid promoters who can basically deliver the goods. So the Bank Nifty or the banking ETF I realized have had a very, very rough time in the last 12 months, in the trailing 12 months. But the 2 and 3 year period returns were ranging between 7.5 to 7.85%. Now, the problem is that after taking the effort of investing into something that keeps going up and down and is going to cause you some amount of anxiety, how much are you exactly getting more than a bank fixed deposit by deploying your money at 7.5%? Not much. So if you're one of those investors who like to rejig their portfolio or possibly keep asset allocation wherein you have to invest in every sector or as many sectors as possible, then probably you have no choice. You might want to deploy some money in the Nifty Bank or the banking ETFs. I would suggest you look at Nippon Bank Bs. Highly liquid, relatively low impact cost, and basically entry and exit tends to be therefore relatively easier. Now, coming to the Nifty ETFs. I basically found there to be a lot of ETFs available out there, but surprisingly, and this should actually come as no surprise because since the last couple of months, I have been waxing eloquent about the virtues of investing in PSU stocks. So now you will see from this list that the PSU, government sponsored companies that are offering you ETFs of the Nifty 50 are actually outperforming many of their private sector peers by a decent margin. Now do remember that the Nifty is a passive ETF and therefore the difference between the top and the lower ended ETFs in percentage terms is not going to be all that great. But hey, every basis point counts and therefore we are going to go for it. Now, based on 1 year returns, I found the LIC mutual fund Nifty 50 ETF to be number 1 because it returned 19.7%. Number 2, Nippon Nifty 50 or Nifty Bs, which returned 19.54%. Number 3, SBI Nifty 50 ETF, which returned 19.48%. The others are basically below 19%, so I'm leaving them out. So clearly, my choice at number 1 for Nifty 50 Nifty ETFs would be LIC Mutual Fund Nifty 50 ETF. Number 2 would be Nippon. Number 3 would be SBI. So 2 PSUs, 1 private sector ETF. Now, where volumes are concerned, traded volumes are obviously the most liquid in Nippon Nifty Bs. And then you have SBI and LIC Mutual Fund respectively. Getting in and getting out should not be much of a problem, but do note that the last 2 or 3 trading sessions, and this is something that I found peculiar. The volatility in the Nifty 50 ETF was far higher than the Nifty spot or the Nifty future. So keeping limit orders when you're buying ETFs. Now obviously it is a deliverable instrument. You can't short sell it. So the only advice is to buy it. Of course, you'll have to super time the entry and exits yourself. The point I'm trying to make is that do not enter market orders. Always stick to your limit, because the volatility, especially in the last 2-3 days, is mind-boggling. It's 2 to 2.5 times more than the spot or the futures. Now, coming to the surprise entrants in this list is the Sensex ETF. Although technically speaking, the Sensex is just like any other index, the Nifty or the Bank Nifty or any other index, like I said, the returns offered by this ETF over the last 1 year, 2 year and 3 year period is higher than the Nifty 50 or the Bank Nifty ETF. Bank Nifty ETF, like I very point blank told you, has been terrible. 1 year returns have been pathetic, negative, and 2 and 3 year returns were ranging between 7.5 to 7.85. But take a look at what the Sensex ETF is giving you. Now here again, I notice a lot of public sector Sensex ETFs which are doing extremely well, fairly liquid, and they are also surpassing their private sector peers in returns per annum. Now, I'm depending heavily on the 1 year returns because of the recency bias. Obviously, the kind of returns that were made over the last 1 year seems to reflect the investment or trading style of the fund manager the most, because it's the most recent. And secondly, the reason why I'm giving a higher weightage to 1 year returns is if a fund manager is underperforming his peers in this kind of a market, maybe he is not able to or she is not able to ride the momentum properly. So I'm ranking SBI Sensex ETF at number 1, very close second UTI Sensex ETF. Both have returned 20.18% over the last 1 year, with SBI giving 18.48% over 2 years and UTI Sensex ETF giving 18.5% over 2 years. Almost mirroring each other. Now, at a close number 2 is LIC Sensex ETF, which has returned 20.15% in a 1 year period. Of course, there are others. You have the HDFC Sensex ETF, which returned 20.10%, and the Nippon Sensex ETF, which returned 20.07%. So, you see, we were looking at ETFs in the Nifty and the Bank Nifty, but surprise, surprise, came the BSE Sensex ETF also. There are, of course, other ETFs like consumption ETFs. There is the CPSE, and unfortunately, the problem lies in the liquidity, traded volumes, impact cost, which is the difference between buy and sell and the difference between the first lot, second and third lot. The price gap between them is so wide that you'll wind up paying a lot in execution costs, commissions and taxes itself. So friends, I hope this answers your query about which Nifty or Bank Nifty or now the Sensex ETF is good for trading. I hope you're absolutely satisfied. This video answers your queries, and I'll of course be coming out with more videos in the near future. My budget series videos are definitely on. I hope we are able to make good money before and after the budget through these videos. On this cheerful note, I'll bid goodbye to you, not before reminding you to click like on this video if you're watching it on YouTube. Do click on the bell icon to receive instant alerts for fresh videos uploaded on this channel, and subscribe to my YouTube channel if you haven't already done so. In the comment section, do let me know what you think about this video and what you would want me to record in my next. Also, help me reach out to fellow like-minded traders who are interested in knowledge-based investments and trades by referring my video to your family and friends. Do take very good care of your health, your investments, your family and friends. Have a very, very profitable day ahead. Vijay Bambani signing off for now. Thank you for watching me. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.